Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of XTB, and it's my pleasure to have you at our weekly trading webinar. So let's go down to the point because we are ahead of very intensive week, probably the last such intensive week this year, and week stuffed with a lot of macroeconomic publications and events. The most important event this week is the FOMC decision. This will be our focus today, as potentially Hawkish Fed could change market conditions for many months ahead. But let's start from what's hot on Monday morning. As you can see on this chart, it's Apple shares that were rocketing higher last week, fueling rebound on US indices. So despite Omicron, despite potentially hawkish Fed, despite inflation being at nearly 4 decades high, US indices, especially S&P 500, but also Nasdaq 100, are very close to all-time highs. The Apple stock, as you can see, has as much as 12.5% share in Nasdaq 100 US 100-hour platform and 7% in S&P 500 US 500 on X station. So really this stock is able to propel the indices nearly on its own, and it was supported also by Microsoft, and that's the main reason behind such a quick rebound on US indices. Yes, Apple is extremely overvalued looking only at indicators, but then again, you never know, how much it can go further before it eventually sinks. You could recall we discussed Apple last week, where I presented top 10 picks for December, and Apple was my pick for past 2 quarters as well. So so far so good. It was overvalued 6 months ago, and yet it was able to gain nearly, I think, easily 50% since then. So yes, it could be overvalued, it could eventually crash, but for now the stock keeps doing well and keeps propelling US indices higher. Other markets are also recovering. Oil recovers as Omicron fears fade. Basically, we had vaccine producers last week assuring markets that their products were efficient against Omicron risks, and on top of this there will be new ones. So no need to be worried. Euro dollar, gold stable ahead of FOMC decision this week. We will look at the chart in a few minutes. And Bank of England, Central Reserve Bank of Turkey, and a lot of US data fill the calendar. So let's go through these events one by one. So let's start from the FOMC decision, which is absolutely most important. As you can see on this chart, Fed really poured a lot of money onto the markets last year during the peak of pandemic. A lot of this was initially taken over by US Treasury, and then US Treasury reducing their cash reserves actually spilled this over the markets this year. So even though the QE this year was relatively milder, we also were receiving additional money from Treasury as they simply reduced their bill issuance and some bond issuance, and therefore market conditions turned into massive over liquidity over the past few months. So you had a lot of things like initially GameStop, then crypto, then Tesla stock, and now Apple stock, and all of this is because investors do not know what to do with their money. They don't want to obviously lose on negative interest or even 0% interest where they have 7% inflation in the US. So they want to allocate the money somewhere, and because they have so much of it, this inflates asset valuations. So this is the chief reason why this week's decision of the FOMC could be so important. Of course, they will not change market conditions overnight, but because they are the main pivotal force on the market, as you can see here with the ECB, the blue part of this chart, they are printing in a relatively stable way. They will reduce their printing next year from March as the PAP program ends, and will be replaced by typical asset purchase program, probably in some larger scale that it's now since April, but they will be printing because the governments in Europe are completely dependent on the ECB, especially in the south. But on top of ECB, you can see Bank of Japan already printing relatively small volumes, and with the Fed finishing their program probably towards the end of the first quarter of 2022, market conditions will change quite dramatically next year in terms of liquidity. And the Fed, obviously, they have all the reasons to do it. You can see inflation is already 6.8%, it's highest since 1982. New job claims data are the best since 69, more than 50 years. ISM, which is indicator of how companies feel about the business prospects, are the best in nearly 20 years for both manufacturing and services. And then, even though the latest NFP was somewhat mixed, as you can see, unemployment rate already recovered 94% of the rise of the COVID-induced increase. So obviously, if the Fed wanted to act on the data, they would have acted already much faster than they did. But what's important is that Powell, during his testimony 2 weeks ago in Congress, he made a shift. He said inflation was no longer temporary, and his comments were echoed by other FOMC members. So it's very likely that they will follow through and they will actually increase taper and probably point at higher interest rates next year. Markets expect already first hike in May, which is relatively quickly, I would say, but this is well supported by the data. And if the Fed, if they don't eventually, get scared of what they plan to do, this is really, really possible. So watch for this decision. It's Wednesday, 7 p.m. GMT. A conference starts 30 minutes later. For me, this could be the most important FOMC decision this year. And what kind of market consequences we are talking about? Well, first of all, you have markets that are tracking this interest rate expectations very closely, which is FX, especially euro dollar. As we were discussing for many weeks now, is in a strong downward trend. And even though there was some kind of consolidation and there was an attempt to rebound after Omicron, then this downward trend is intact, and the lower limit in the channel now acts as a resistance. So it's still very possible that downward trend can be resumed on a hawkish Fed. Then there are markets that are kind of in between, they're kind of neutral, they're kind of waiting to see what's going to happen, which is gold and silver. Especially situation silver is interesting because it's very, very close to this 21.6 support. After a huge rally between March and August of 2020, silver was stuck, and yeah, right now it's close to this lower limit. So investors on this market need to be on full watch of what Fed's going to communicate, because if the Fed is really hawkish, we can crash through this support and move lower. So as you can see, nothing here to treat as a potential strong support. So it's very important, because on one hand it might be a good opportunity. Yeah, it's strong support, it worked before, so yeah, you could think why not. But then if the Fed is really hawkish, we can really make a move lower. So definitely want to watch. And markets that are really not paying attention to the Fed, and they should be, are the US equities. As you can see, they are completely sanguine, especially S&P 500. They are back at all-time highs, even though the Fed already signaled they wanted to move. Obviously, as you can see, this is nearly hidden, and these are highs before the pandemic. Since then, we had a full recovery very quickly, and then a huge, very stable bull market, which obviously was fueled by this over liquidity. And as I say, of course, market conditions will not change overnight. But if the Fed is serious about fighting inflation, as Powell communicated 2 weeks ago, these market conditions could potentially start changing from month to month, and denting this bullish sentiment. So this is really something that warrants attention, and this kind of sanguine approach could end badly for some investors who are too reckless. But we'll see. Right now, obviously, these markets are in a strong upward trend, and and yeah, it's obviously always risky to bet against them for as long as this sentiment is there. Okay, let's move to key events for this week other than the Fed, which is Bank of England decision. So let's start from there. Bank of England actually was expected to act already in December. However, due to Omicron, these expectations moved to February. So the first hike, as I showed you before, for US, it's expected in May, whereas in UK it was expected already now, but now it's February. Yeah, we'll see. You know what the statement is, because if Bank of England is serious about interest rate hikes, it can have obviously some serious ramifications for the British pound. Watch Euro pound as interesting part here, because as you can see, since Brexit referendum, this pair has been trading in a pretty wide but still a range, and we had some attempts to move lower, which weren't successful. You know, the most serious attempt was stopped by the pandemic. Yeah, and we were already close to moving lower, and obviously in high risk of situations, usually the pound loses versus the euro, and that's what happened in the spring of 2020. But now we are close again, and if Bank of England turns really hawkish, there will be enough ground to break lower here. So definitely one event that is worth watching for pound investors. Other than that, we have plenty of data in the US. Most critically, we'll have retail sales on Wednesday, so on the FOMC day. I don't think it's going to change much, because as you can see, the demand in the US is already at some insane levels. It's fueled by obviously the checks that were financed by the FOMC. So it's much stronger than it would have been without the pandemic, which is a trend, you know, pre-pandemic trend is the black line here and here. So obviously I don't think, even if the monthly data is weaker, it really wouldn't change much from the Fed perspective. Other than that, we have PPI on Tuesday, we have December's Empire on Wednesday. We had some long list of data released on Thursday, but I don't think markets are going to pay too much attention to Thursday. That they are paying attention to the Fed on Wednesday. We'll also have PMIs for December, flash PMIs from December from Japan, Europe, and US. You know, on the surface, it obviously looks great, especially in the US. We have record levels, so you could see, well, it's great, right? But then, obviously, we are aware that companies report a lot of issues beneath the surface, and you know, supply chains issues, problem with finding employees, and obviously high input prices are all the worries that could translate into potentially slower growth unless these issues are resolved, because all the stimulus is going to start fading next year, and then we have lower demand, and if these supply side issues are not resolved quickly, then obviously we may face eventually a quite awful slowdown. And finally, last but not least, central bank decision in Turkey on Thursday as well. Turkish lira, I mean, this is really, really incredible how, you know, you can really destroy your own economy. And I'm talking about President Erdogan here. Look, one month ago, in the middle of November, Turkish lira was already weak at 11.4 against euro, but now it's 16. So it's absolutely incredible. No, it's not depreciation or devaluation. It's a real crash caused by reckless economic policy. And as you can see here, even though interest rates nominally they are double digit, then with inflation like this, dependency on external capital, and therefore deeply, because you have such a high inflation, deeply negative interest rates, real interest rates, this is obviously all hurting the lira. And yes, market is very speculative right now, and it could turn in either direction because of this, you know, nervousness. But unless something changes in the economic policy front, the lira is going to be under pressure. All right, ladies and gentlemen, thank you for your attention. Please stay with our news section where we report all of this, data releases, the Fed, market developments. So you can watch our news on Xstation and Xstation mobile platforms. And I see you next week on Monday.